Stocks oscillate in a band after an overnight sell-off in the U.S. on weak economic data. The PSU stocks and oil and gas names gain while utilities and consumer durables drag. IndusInd Bank reports a strong performance in its core business, but credit quality concerns on its micro loans and uncertainty over leadership continue to keep the street in check. Infosys MD Salil Parekh says the company is actively looking at new acquisitions as valuations become reasonable. Also tells CNBC-TV18 that the deal pipeline is stronger than it was a year ago. The Adani Enterprises stock sulks ahead of its 20,000 crore rupee FPO as new shares will be offered at a discount to the current market price. And Persistent System gains on delivering stronger margins. Vedanta is up on winning the bid for the Meenakshi Energy, and SAIL Parks up on analysts turning upbeat on its prospects. Hi guys, good afternoon and welcome to Business Lunch. I'm Pavitra Parekh. Those are the top headlines that we have for you this afternoon. There's a lot going on, a lot of stocks moving around. For the market, we're currently looking at a 45-point dip. But I guess the big story today is the fact that we have come significantly off the day's low, and especially considering the kind of weak handover that we did start off with. So from those levels, we've definitely seen quite a recovery play out. And this is not specific just to India. We've actually seen that throughout Asia as well. All of those markets, barring perhaps just the Japanese Nikkei, have seen quite a recovery come through. So do watch out for that. In terms of the indices, you have the mid-cap index, which is actually doing a lot better than the frontliners. It had also moved into the green briefly, but currently it's just around 40 points in the red. The Nifty Bank currently around 170 points lower. But, there are a lot of names like HDFC Bank, which are holding it together. Axis Bank, ICICI, which were doing well in the morning, have actually slipped to the low point of the day, which is why you're seeing a little bit more weakness come in over there. What's doing well, you have some of the PSU names, so the likes of ONGC, Power Grid, Coal India, some of these holding up well. The entire HDFC group is doing quite well. But on the downside, it is consumption, which is taking a little bit of a knock. So do keep that on your radar. And also the entire Adani group of stocks is something that is under pressure today. That's what's going on with the market action. We will talk more about this. But let's now talk about some individual earnings which came through. Persistent Systems is the stock of the day. It's up almost 6%. And this after the company reported a good set of third quarter numbers. Revenue growth was at the upper end of their guided band. Margin expanded by around 75 basis points for the quarter, and deal wins also remain quite steady. Earlier today, we spoke to the company's executive director as well as CEO Sandeep Kalra on what he really made of the quarter gone by and how the outlook looks for the company on both the revenue as well as on the margin front. So let's listen in.
Sharp drop-off that you're seeing is pretty much due to the seasonal furloughs that we see. If we look at the furloughs this quarter gone by, for the industry, it is a little higher than what it used to be in the regular terms. For us, the furloughs came in at about 1.5%. And it also contributes towards lesser number of working days in the quarter due to Thanksgiving, Christmas, and other holidays, both in India and the US. So overall put together, roughly about 2.5% is roughly the impact because of these, both put together. If we look at our top 2 customers, outside of that, the top 50 customers grew at a healthy 7.7% sequential quarter-on-quarter and 53.8% year-on-year. As a company, we have clocked the highest ever bookings in this quarter, which is a TCV of $440 million. This is the first time for a company that is doing $1 billion revenue run rate. We have crossed 400 millions in total contract value. So from those parameters, we are pretty optimistic that the deal wins and overall the momentum that we have, despite the macro, will carry us well through the next year. But if you look at the run rate, we are at a fairly healthy clip. And given whatever run rate we have, we will land up at least at 30% plus growth for FY23.
Right, the street definitely likes the sound of that, saying that the total contract value in the past quarter is the highest that it's ever been. They're also looking at a full year revenue growth of around 30%. But staying with the tech space at the World Economic Forum, which is underway in Davos currently, Shireen Ban caught up with HCL Tech chairperson Roshni Nadar Malhotra, TCS's MD and CEO Rajesh Gopinathan, as well as Wipro chairman Rishad Premji on the broader outlook for the IT services sector. So let's listen in to what all of them had to tell us.
Even though the last couple of years of the pandemic have been one where everybody had moved to a work from home environment, and we were all taking caution on a couple of our expenditure and how the company was evolving, I think one of the things that you've seen is that for us, we've really ramped up and continue to ramp up the pyramid mix. So the number of freshers that we're hiring, and I think that's also now starting to show in the way we're improving our margins. And that's a strategic direction we want to continue taking. What we've done over the last couple of years and continue to do even now is we've opened quite a few nearshore delivery centers. So, you know, we've got Morocco, we've got Vietnam, we've got Sri Lanka. Despite, you know, the economic turmoil in Sri Lanka, there wasn't a day of billing we lost. You know, there's Mexico, there's Costa Rica. So there are many of these new centers that we're opening. So again, expanding on the nearshore delivery model is something that we're going to continue to pursue.
All right, that is the word coming in. But with that, let's also move on and bring you some news from the telecom sector then. Brokerage house IIFL has issued a note on the telecom sector, citing arguments both for as well as against the tariff hikes in the sector. So Reema is here to fill us in with all of the details on this one. Reema?
Thanks so much for that. So, you know, for a telecom company and the financials, the tariff hike is the most important metric. Now, when it comes to the recent tariff hikes, well, it's not taken place. The street was anticipating that in December of 2022, that's last month, the companies would go ahead and announce a tariff hike, which would be exactly 1 year post their, prior tariff hike. That didn't take place, which is one of the reasons why Bharti Airtel in the last couple of days has been an underperformer. Now, IIFL has come out with an interesting note where they're making a case both ways, why companies should hike tariffs and why companies perhaps will not hike tariffs. So the arguments in favor of a tariff hike include: one, there is a rising urgency because Vodafone Idea, the third player, private player, is struggling a bit. A tariff hike will help Vodafone Idea survive. Secondly, Jio and Bharti Airtel's net debt to EBITDA is over 3x. If you go ahead and do a tariff hike, then the leverage ratios come down because the EBITDA gets boosted. Third, the companies are making significant investments in 5G. So you want to raise some money and shore up your financials by going ahead with a tariff hike. Fourth, a potential Jio IPO is down the corner. So before that, Jio would like to bolster its return ratios to make it more attractive to investors. Another point, they're saying the incremental revenue market share for Bharti Airtel and Jio has been coming down because the pace at which Vodafone Idea was losing subscriber, that pace has abated a bit. So that's another reason. And finally, Bharti and Vodafone Idea's ARPU is still below the 2016 levels, which is prior to when Jio came through. And this is despite 2 increases in the tariff hikes that we've seen in the last 3 quarters. So tariffs are still below what they were before Jio entered the telecom space. But the arguments which are against a tariff hike, they're saying the consumption environment is weak, and therefore, even if they do a tariff hike, it will not get absorbed. There will be people who will give up their SIM card or they will downtrade. 2, there is a sharp jump in data capacity planned by Jio and Bharti Airtel in the next 18 months. So that is another factor. So on the whole, it's just an interesting observations made by IIFL on the factors which go ahead, which go into hiking tariffs or not hiking tariffs. On the whole, they believe the recent correction by Bharti Airtel offers an attractive entry point. It is their top pick with a target price of 909. Back to you.
All right, Reema, thanks a lot for getting us all of that information. But with that, we are going to get into a short break on the show now. When we come back, the government is proposing some big changes to the insolvency and bankruptcy code. Welcome back. You're still tuned into Business Lunch on CNBC-TV18. And let's get you some more commentary coming through from Davos. Shireen also spoke with Amitabh Chaudhary, who's MD and CEO at Axis Bank, and he said that the government's policies will support capacity expansion. He also believes that the rate hike cycle is now coming to an end.
I think the government's policies have been supportive of foreign investment and general capex. So in that sense, I'm seeing a lot of euphoria around India. I'm just hoping that all this promise which we are showing, we can execute on it and deliver the results. And if we can, I think this could be a very, very important period for India. I think in the short term, the interest rates obviously are going up. As far as the long-term rates are concerned, I think they will follow more. I would say the interest rate hike cycle is almost coming to an end. So in that sense, you are expecting a slightly more confident, stable environment going forward. No, right now I'm not seeing a slowdown at all as far as the real estate market is concerned. If you go and talk to the real estate players, very, very positive about how they see their sector story play out. Especially on the residential side, they have suffered quite a bit for a long period of time. So they do believe the timing is right and things should work out quite well. I think with more and more data becoming available to Indian banks, our ability to underwrite the customers is also improved. So now we can give more to our customers, underwrite better, price it better. So in that sense, potential for a customer to go and raise a little bit of money to buy real estate has also improved. And I think it will continue to improve over every.
All right, that is Amitabh Chaudhary from Axis Bank. But with that, let's move on to the hot defense space now. Bharat Forge has been betting big on the defense space, and Deputy Managing Director Amit Kalyani also says that the company's defense business is actually likely to hit an inflection point in this year itself, that is in 2023. So let's listen in to some of those comments.
So this year, that is the year ending 23-24, will be our inflection year. This is when we will see significant growth in our defense business, and year on year, this year, next year, year after next, will continue to grow. And I think the Indian government has taken a very strong and right view in encouraging local production and mandating local manufacturing for many sectors, which there is no reason why we shouldn't be making in India.
All right, the big Make in India push for defense, that is what has got all of the defense stocks also very excited in trade off late, with them seeing gains between 50 to 80% in just the 1 year, in the past 1 year as well. So that's what's happening with defense. But with that, let's move on and bring you another important story. The government is proposing some big changes to the Insolvency and Bankruptcy Code. The proposed amendments could actually spell some relief for real estate developers as well with stressed projects. So Sapna is here to fill us in and bring us up to speed with all of the changes that have been proposed. Sapna?
Well, first of all, what is being suggested is giving a 14-day mandate to the adjudicating authorities in terms of either accepting or rejecting an IBC plea. Basically trying to expedite the whole process. Second, of course, in terms of the real estate projects, some of the units which are under stress, so the amendments propose separating those stressed units which need the IBC proceedings, separating them from the rest of the entity, because the rest of the entity is completely functional. But many a time, suspicions are cast because just one unit has defaulted, so people look at the entire project in askance. Government here is trying to separate the two, and I think this could be a boost for real estate developers facing some kind of a stress in some of the units. Apart from this, of course, trying to expedite the pre-packaged insolvency framework also. What is being suggested is that the voting for the COC, that can be reduced in terms of accepting such applications under this framework from 66% to 51%. And also bringing more CDs under the pre-packaged insolvency framework. Of course, these CDs are going to be prescribed, and I'm sure the government will come out with more rules and notifications once at least these basic amendments go through. Apart from this, it is also being suggested that the corporate debtor will not have the power to appoint the insolvency professional. This will now be done if the amendments are accepted by the IBBI, which is actually the regulator for IBC. Also, the pool of assets of a corporate debtor's guarantor, that should also be included under IBC. Apart from this, the government is also trying to strengthen some of its own powers. For example, it is being proposed that they should have the right to appoint an administrator under IBC. The work will work as per the code, but the COC will not have the power to remove or replace such a government-appointed administrator, and all the work will be handled by the administrator. Last but not the least, the government is also trying to suggest that some powers should be given under the code to exempt a certain class of companies from the IBC. Maybe a separate kind of a window should be thought about them. No details as such, but maybe something will follow through in rules and notifications. All in all, the public comments to these important amendments are invited by February 7.
Sapna, thanks a lot for taking us through all of those proposals. This would really come as a shot in the arm for a lot of the stressed real estate developers. But another important story is that top pharma companies have now approached the Bombay High Court. They're seeking clarity on the treatment of free samples and gifts under GST. So Timsi is here with all of the details. Timsi, what are you picking up?
Well, that's right. What sources are telling CNBC-TV18 is that the pharma majors have approached Bombay High Court for clarity on free samples and gifts to be considered as genuine expense under GST. Pharma majors feel that free samples and gifts are cost to the business, therefore business promotion and marketing, and thus wrong treatment under GST is leading to blockage of ITC under Section 17(5)(h). Also, CBIC, on the contrary, feels that these free samples and gifts are part of sales. They are not to be entitled as input cost for the company. Let's see what happens finally, because now Bombay High Court has issued notices to Union of India, to CBIC and GST Council to defend the case. Let's see what happens finally. Back to you.
All right, Timsi, thanks a lot for bringing us all of the details on this one. With that, it's time for another short break on this show. But you guys stay tuned, because when we come back, we're going to bring you excerpts from our conversation with Minister of IT Industries of Telangana, K.T. Rama Rao. So stay tuned for that. Welcome back. You're still tuned into Business Lunch. No big shift in the market. We're still around 45 points lower, but the Adani stocks are moving even lower. So take a look at Adani Ports. It is at the low point of the day right now, around 1.5% in the red. You have IndusInd Bank, which has moved to the low point of the day. So that's something that we're looking at as well. And ITC has seen quite a sharp drop in the past few minutes, once again at the low point of the day. So that's what's going on with some of the larger names. But let's now bring you some more from Davos. We present our state as a gateway for investors. That's the word coming through from Minister of IT and Industries of Telangana, K.T. Rama Rao, as he speaks to Shireen Pan on India's increasing presence at Davos. So let's listen in to that interesting conversation.
We presented our state as a gateway, the absolute right gateway to enter India through. That's what I tell all the investors. In fact, when they draw this oversimplified comparison between China and India, I tell them India and China are as different from each other as are, say, Jack and cheese, right? The point is, India is more like Europe in the sense of 28 different states, different languages, different cultures, different styles of functioning. It's a federal setup, a lot of autonomy to the states. So I tell the prospective investors that while we all work under the larger rubric of Government of India, the fact is the real action when it comes to investment is in the states. Yeah. So land, power, water, money, whatever you need in terms of fiscal incentives, all of that really is vested with the state. The other thing I also realized in coming to VEF over the last 5 times is that there are collaborations to forge, and that's why this time around, in fact, while we of course have focused on investments and MOUs, we also have announced a Center for Industrial Revolution in association with the WEF, the World Economic Forum, focused exclusively on life sciences.
Governments don't have a significant amount of green that we spoke of. Fiscal space is constrained at this point in time. So when you talk to investors, are they asking you to put subsidies on the table, or are they asking you to basically ensure that it is a frictionless environment that they get to operate in? Do you have the capacity to keep doling out subsidies to try and lure in investment?
But it's a pretty interesting question because, on the one hand, every single government across the world and possibly across within India as well, if you take all the states into account, we have grappled with this problem of balancing welfare and development and ensuring that while we create wealth, while we create employment, we also ensure that the vulnerable also are taken care of. The biggest challenge today, if you ask me from a government perspective, of course, are the impediments in the way of capital infusion into our economy.
Fiscal space being one of the challenges that you face in government. Outside of that, what are the other deterrents to growth that you want to deal with as you progress through this year?
I think we have to get off our high horse. Basically, governments have to get off our high horse and start wooing investors more. Because you have to realize, today if Elon is setting up a new factory, he has a choice to set up anywhere between Thailand, India, Malaysia, Vietnam, Indonesia. To sit on this high horse and say that we are a 1.4 billion market, so therefore you have to come to us and you have to manufacture. Sorry, but that's not how the world works. I think if you really want to go out aggressive, all out aggressive, then you really have to step down from your ivory tower, come see the world, and understand that the world doesn't really think.
All right, that is very interesting conversation about attracting investments into the state and also into India. But by the way, take a look at the ICICI Securities stock. The earnings just came through and there's been a sharp knock that's come through in no time at all. The net profit is down 26% in this quarter. You've seen the revenue down 7%, EBITDA is down 10%. So there's the stock on your screen. It's currently 2% lower, and sharp knock coming through ever since the results really hit the exchanges. The margin has also seen a contraction coming in at closer to 62% versus the 64.5%. So this is a stock that you should watch out for. But on that note, we're going to wind down on this edition of Business Lunch. You guys stay tuned. Midcap Radar comes up next.